The Magnificent Seven stocks like Amazon and Meta and Google and Apple and many of them are one of the best companies in the world that you could own in your portfolio. There was so much hype and so much attention around the Magnificent Seven, and people were owning big tech, saying why big tech always wins and why you could just own big tech and outperform the S&P 500. And it's been amazing to me to watch how quickly this sentiment has shifted, because investors are comparing Meta to Micron and they're feeling bad that Meta is underperforming Micron instead of taking advantage of those amazing opportunities on one of the best companies you could own in the entire stock market. So I'm going to talk about the outperformance today of the Mag 7 versus the S&P 500, talk about why it's happening, talk about why I believe we're nearing the end of this underperformance, and why I'm betting a decent percentage of my portfolio on this outcome. So I really hope you enjoy it as always. Now, most of you guys know why the Mag 7 have been going down. There has been spending a lot on CapEx. It's been getting out of control. This year in 2026, expected to be $805 billion combined. In 2027, expected to be $1.1 trillion on AI capex. This is a lot of capex for those companies, and the market is asking, okay, you're spending this money, but where's the return? And investors are selling those stocks like never before. Now, if you look at the free cash flow of the Magnificent Seven, the free cash flow margin is about to turn negative for most of them. Amazon, it's negative. Meta, it's almost negative. Apple, Alphabet is about to turn negative, and Microsoft is the most profitable one by far on a free cash flow margin. So those companies have spent pretty much most, if not all, of their operating cash flow on AI capex. They even took a lot of debt to fund AI capex projects, and they even are raising equity. Like Google is raising equity, Meta is looking to raise equity to fund AI capex because they spent 100% of free cash flow. They took on the debt. There's nothing else to do but to raise cash, and investors are pressuring those stocks. Now, I personally believe that Google raising money via equity dilution for them to spend on capex is likely going to mark pretty much nearing the end of the capex cycle. I'm not saying capex can't go up from here, but those companies are running out of options, guys. They spent all the free cash flow, they took on the debt, they have nothing else but to dilute stock, and this is unsustainable. Most of them, if those stocks go down more, they will give in. A lot of their composition is in stock, so I don't believe that's going to be sustainable. I believe we're nearing the end of the capex cycle. It doesn't mean capex will stop growing, but I think it means that the pace of the growth is going to slow down in a major way as those companies are running out of options. And even Meta is looking to crack down on skyrocketing AI costs by imposing limits on employee usages. So if I'm right that we are nearing the end of the parabolic capex growth, and then those companies will at least keep capex the same, but expand operating cash flow, then free cash flow will turn back positive, and investors will be piling in those stocks like never before. So I'm going to talk about the first one, and this is a quick review of Microsoft. Microsoft is an amazing company. It's down 17.5% over the last year. Bill Ackman is seeing an opportunity. He actually commented under my post that he's selling Google and buying Microsoft versus Chris Hohn, which is selling Microsoft and buying Google. So that was a pretty interesting debate. He believes the stock's undervalued, and he's buying a lot of Microsoft. Now, Microsoft has a lot of call options coming up for the company. The first one is the OpenAI IPO. So there's now a 48% chance that OpenAI will likely IPO at about $1.5 trillion. We've seen what happened with SpaceX. They IPO'd at it's like $2 trillion right now. And OpenAI is growing revenues much faster than the SpaceX. Their Codex product is getting better. And OpenAI, I look at ChatGPT, it's actually getting better in general. And they have a lot of power supply secured and compute that Anthropic doesn't really have. So I see OpenAI as still a clear winner, of course. You have other companies, but it's still a clear winner if this is correct. And it opens up at $1.5 trillion. Microsoft's equity stake will be worth $400 billion, which is about 14% of the current market cap. $400 billion to Microsoft's value could be added through this IPO alone. They pretty much bought, I believe they put in like 20 billion or 15 billion, and they could potentially cash out $400 billion. This is a major, major catalyst. Now, over the long term, you have a lot of people talking about quantum computing and quantum computing being the future. Well, one way to bet on it without getting diluted to the stratosphere with ionic and Rigetti computers or whatever they're called, quantum, and they're not going to pretty much never be profitable. You could buy a lot of companies like Amazon is in quantum and even Microsoft, where they have like a next generation quantum chip that could potentially be used in 2029 for a lot of quantum machines, and maybe that's another potential call option with the company. But if we look at how much we're paying for Microsoft, for Azure, and all those amazing businesses growing rapidly, we're paying about 21 times earnings. And a lot of people, again, tell me seat compressions and all these things. You have one of the best CEOs running this company. I'm sure he's looking at seat compressions. I'm sure he's looking at charging per usage instead of per seat. I'm sure he's looking at Azure, how it's growing 40% and trying to maintain the growth. But how much are we paying for this thing, guys? We're paying 21 times earnings. This stock was trading at 35 not long ago. Now it's trading at 21 times earnings. So yes, maybe AI will disrupt their business a little bit in some kind of ways, but how much of that is priced in? The stock is trading at a 50% cheaper valuation than it was just a few months ago, and investors are not liking it because that's underperforming Micron. So I bought Microsoft, I bought the dip on the company, and I'm gonna hold it for the long term. I never owned it before. This is the first year I enter Microsoft, and it's expected to keep growing earnings per share 15%, 16%, and you're paying about 21 times earnings. This is not expensive at all for an amazing company like Microsoft. Now, the second cheapest of the big seven, I would say, is Meta. Now, even though Meta is cheaper on a PE basis, I believe Microsoft is cheaper than Meta. And the reason for that is that Meta is still heavily, like 98%, in advertising. Advertising is much more cyclical than cloud subscriptions and cloud-based revenues and recurring revenues that Microsoft actually has. So even though the PE of Meta is lower, I believe based on how resilient the Microsoft and how recurring it is, I believe Microsoft in this case is cheaper than Meta. But if we look at Meta, again, it's trading at 17 times earnings. I mean, I can't believe it, guys. 17 times earnings for WhatsApp and Threads and Instagram and Facebook and Oculus. And now you have Manu.ai, and you have a founder CEO, very young. He's likely going to be here, hopefully, for the next 30, 35 years. For 17 times earnings, I think that's a pretty good deal. But again, a lot of investors have a lot of scars and recency bias from the metaverse because Mark Zuckerberg blew it away in 2022, and he wasted a lot of money on the metaverse and also on some other project as well. He spent 62% of operating cash flow on CapEx back then. Now he's going to spend about 61% on CapEx. Now, if we look at what happened after 2022, this CapEx has reignited a lot of growth within Meta up to 27%. And here we are about 2 years later, Meta is growing 33% in revenues, guys. 33%. This is absolutely mind-blowing. So yes, some of the CapEx went away to waste on the metaverse and all these fancy projects in the moon or whatever they are and land in the metaverse or whatever. But a lot of it was actually useful, and it's blowing up the company's revenue growth. That's pretty amazing. And I think 16 times earnings is really cheap for a company like Meta. Now, the third one, which is my favorite one, my largest position, this is Amazon. Amazon is down 10% over the last months. Now, this one is positive year to date. The market was realizing the value, but it has recently started going down, and it went down about 10% on the months. With Amazon, I did so many videos on it, so I don't want to make it too long, but you have Amazon Web Services. It's been reaccelerating like never before, from 16%, 17, 20, 23, now 28% growth for Amazon Web Services. And by the way, I'm using Fiscal.ai to come up with all those charts. If you want to try it out, it's give you 2 weeks of free access if you use my link in the description. But if you look at the demand for Amazon. I mean, it's really crazy. Like the CEO of Amazon Web Services said that the company has never retired a single A100 server. They're still using the A100s because the demand by far pretty much outpaces supply, and it's not even close. And they're seeing so much demand that they are investing heavily into into a lot of the cloud business, and it's growing rapidly. So what would you prefer the company to do? Would you prefer the company to invest where they're seeing an opportunity and reaccelerate growth in general, or would you prefer the company to give it to you as a dividend or as a buyback program? Now, Wall Street loves buybacks and dividends, and they reward those companies. But if a company is sacrificing short-term benefits for the long term to reinvest in growth for the long term, Wall Street punishes the stock. But as a long-term investor, you should always want a business that can reinvest wherever they see opportunities versus a dying company that's only doing buybacks and dividends with little to no room for growth. Now, if you think of Amazon and you think of a lot of the businesses that they have, the robotics business, they have Amazon Leo in space competing with Starlink, they have the logistics business, they just have so many amazing businesses within Amazon. How much are we paying for Amazon? We're paying 13 times operating cash flow for a company that's growing operating cash flow about 30%, expected to grow 33% this year, 29% next year, and about 25% in 2028. This is like a half a peg ratio. It's really cheap for an amazing company like Amazon. And again, the main argument is that why would you use operating cash flow if the company is spending so much on capex? But the truth is, guys, the company is spending 140 billion on capex. But if you look at the businesses of Amazon, none of them require 140 billion of capex to keep them alive. Like Amazon's third-party business doesn't require 140 billion. The subscriptions of Audible and Amazon Prime don't require 140 billion capex. The only one that requires a lot of capex is some of the Amazon stores, which is Whole Food, and maybe Amazon Web Services, and maybe they require 30, 40 billion, but not 140 billion, which means most of the capex is gross capex, which means the company can decide to cut it back any times, but they're not doing it because they're investing for the long term. And that's really amazing from the company. Now, the next one is Nvidia. Nvidia to me is very, very interesting. The stock is still up 8.5% year to date. I'm going to keep it short on Nvidia. The stock is trading at 20 times earnings. 20 times earnings is very cheap for a semiconductor like Meta, especially if I compare it with other stocks like AMD, which I believe is overvalued, like Marvell, which I believe is overvalued, and even Cerebras, I've been saying, it's a little bit overvalued still. But looking at a lot of the semiconductors, I see Nvidia and I see AVGO as the best valued two of the semiconductors, but the cheapest one by far is Nvidia. It's not even close. You have an amazing CEO running the company at 20 times earnings for a company that's expected to grow 87% this year, 42% in 2028, 24% in 2029. Even if half of those numbers are true, 20 times earnings is not expensive at all for a company like Nvidia. Now, after Nvidia, I have Google. Google has been one of the best performers. It's up 14% year to date, pretty good for the company. Now, looking at Google, it's an amazing business. You have Google Search, you have YouTube, you have Google Play, you have Google Cloud, and you have the SpaceX stake, of course, which I was surprised for SpaceX to go public and Google not being even up 1%. Given the fact that they own 7% of SpaceX. So that was surprising to me. The company also has Gemini. Gemini has been, you could say, killing ChatGPT on this front. It's been taking a lot of market share. This is really good for Gemini. They have Google Cloud, which has been a beast, not just improving growth, but also improving profitability growth or operating income growth. And again, that's really good for Google. But I've said it before, I'm going to say it again, that the easy money has been made with Google. Over the last 2 years, you had two factors. The first one was earnings growth, so the company grew in earnings. But you also had a multiple expansion from 15 PE to 32 PE, now trading at 28 PE and a half, with an average PE of 23 times. So Google, yes, it's an amazing company. It does deserve a premium. But from here, I would not be betting on a multiple expansion. unless you believe Google deserves to trade at 40 or 50 PE. If that's what you believe, then Google is easy money here. But my main argument is that the easy money has been made on Google. So I'm not seeing a multiple expansion. I'm seeing more of a company that will likely return something close to its revenue or earnings per share growth, which is about 17-18% annual return. Still an amazing return on a company like Google, but I would not put it as the cheapest of the big seven. So that's just why I ranked it before the last one. And the last one for me is Apple. This is a stock that I said before I would never really buy because I like companies. They are reinvesting for themselves for the long term. And Apple doesn't really reinvest in itself. They don't spend a lot on research and development. The company is trading at 32p, not because it's growing rapidly, but because Wall Street likes the fact that Apple is not spending on capex. So only imagine the multiple of Meta or maybe Microsoft, if they decide to follow the Apple playbook, then the Wall Street would reward them. But I like the fact that they're not being rewarded and they're betting on many potential opportunities. But looking at Apple, it's growing it's growing revenues like 2%, 6%, and negative 2%. So the revenue growth is very, very small. But if you look at their earnings per share growth, it's much faster than revenues. And the reason for that is because they spend 100% of the free cash flow on buybacks and they pay a tiny dividend. So this is not my favorite business model. I prefer a company that focuses more on reinvesting for growth rather than doing buybacks and giving it to me as a shareholder. And Tesla, I'm not going to talk about it. I'm not an expert. I don't know anything about the stock. It's been overvalued forever. So I'm not going to comment on Tesla. And that was my opinion on the Big Seven and the opportunities that I'm seeing. So I hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.